You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com and co-hosts Alex the Viceroy Jacobson from Options Express, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com. The Option Block is brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, everybody, that rockin' tune means it is time once again for the Option Block, everyone's favorite bi-weekly source for all things options related. A little bit of wit, a little bit of wisdom, a little bit of analysis, a little bit of education, sprinkle in some unusual activity, and you have the Option Block. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. 13 programs for you to choose from on the old network. So no matter which segment of options you fall into, basic, retail, advanced, you're an institutional guy, you like volatility, you're a financial advisor, you like futures and futures options, I don't care what it is you like, we have something for you on the old network. Of course, you can find it all over there on the mothership, theoptionsinsider.com, from whence everything on the network flows, as well as iTunes, Stitcher, Aha Mobile, wherever you find your finer podcast content, including our mobile app available for iOS, Android, and the Fire OS. Just search for it, and of course, you can instantly stream all of your favorite episodes of pretty much any one of those 13 programs now, as well as download your favorite episodes, build your own playlists, all sorts of cool stuff for when you're on the go, don't have time or access to a signal to stream the show. Then no shortage of ways for you guys to do that. And while you're listening, hit that comment, hit that feedback tab. Let us know what you think about the shows, what you like, what you don't like, questions, comments, whatever the case may be. We love to hear from you. And speaking of hearing from people, the people we're going to hear from on the show today are the usual cast of characters, starting off with the man beaming in from the lovely metropolis known as St. Charles, Illinois. He is Uncle Mike Tusaw from RCM Asset Management. Uncle Mike, welcome back to the show, sir.
Always good to be here on a beautiful fall day here in the Midwest.
It is indeed. And how are things in lovely and scenic St. Charles?
Both lovely and scenic all at the same time. I don't see how life could possibly get any better.
I'm just waiting for my check from the St. Charles Tourism Board, and then we'll be all set.
I think you need to wait for the St. Charles Tourism Board to exist.
That's true. I've sent
However, not many people know that Jenny McCarthy did get married here a couple weeks ago.
There you go. There you
go.
Your big claim to fame. And I'd have to say I've sent at least 3 people to St. Charles over the course of this show, so that's got to be worth something, I would think.
I would think so.
Maybe even 4, but I won't push it. All right, and beaming in from parts unknown, is he downtown, is he out in the burbs, is he underground in a subterranean bunker? We just don't know, but he is the greasy meatball himself, Mr. Mark Sebastian. Mr. Mark, where are you beaming in from today, sir?
Downtown Chicago.
Well, there you go. Where is that? I've heard that's a nice place to live.
It's not bad. It's not bad at all.
All right, with the gang assembled, as I mentioned before, the Viceroy will be back at the end of the month. He is getting some well-deserved rest over there. But that doesn't mean the show stops. No, not by a long shot. We're going to keep on rolling right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. You probably know the drill by now. Unless you're new, then welcome. Welcome to the old program. This is indeed the portion of the show where we break down all of the activity that caught our eye in today's markets. It was a bit of a mild day compared to some of the crazy days we've seen of late. Though we did have a bit of a range to the downside today, but we tested some interesting, and it kind of closed towards the middle of that range out in S&P land. Most of the major indices closing off fractionally on the day. S&P off about 0.1%, Dow following suit, Q's off about 0.25 percentage point, and everything else pretty much following suit. VIX cash ticking up a wee bit, about 0.75 point to 15.3. A little bit of vacillation in today's markets, but certainly nothing as extreme as what we've seen over the past couple of weeks. Uncle Mike, perhaps we'll start with you. What in today's somewhat head-scratching activity caught your eye?
Yeah, today was interesting in that just looking at the futures while I'm working out in the morning, S&P is up 10, and then pretty much right when we opened, we started going down, and we stopped, but we never came back up. There was news that the company that was going to provide the glass for the iPhone that a couple months ago had actually gotten turned down on that, but they were still going to get to provide some glass on the iWatch, filed for bankruptcy. So I think that was something that kind of started this downward movement, but like you had said, it really wasn't too much of a downward movement with which to speak of. In Hong Kong, things still appear to be peaceful, so I think everyone's just kind of looking to be on the sidelines for the time being.
Can't say I really blame them. It has been some whipsaw action we've seen in the markets of late. I can't blame too many people if they want to perhaps sit this one out and see where exactly we are heading. Mr. Mark Sebastian, what caught your eye in today's activity? What was lighting up the old pit chat today?
Kind of the same thing. We were kind of surprised the market turned around, but kind of a blah day. I mean, the NASDAQ was up. The RUT was basically flat. Maybe just kind of a breather day after such a crazy week last week is kind of the way I view things. Adjusted for the weekend, no real change in VIX, just kind of a net day. But yeah, that GTAT stuff was hilarious. So, that was hilarious. It's fun to see something related to Apple go down in flames. We haven't seen an Apple-related product blow up in flames like that since the iTV, Apple TV. So,
yeah, everyone was kind of scratching their heads when they initially announced it so early in the cycle and then said, yeah, it's not coming down the pike for quite a while. A lot of people were kind of wondering if maybe that was a sign that this was a concept and a product that really wasn't fully baked, but they wanted to put it out there to kind of combat just the onslaught of Android devices and Android wearable devices in particular that seem to be new ones announced and marketed pretty much every other week. So at a certain point, there's just inertia that they have to compete with. So it seemed like they were putting that out there to kind of show the flag a little bit and perhaps say, hey, if you're an Apple devotee and you're thinking about getting some sort of wearable for the holiday season, maybe you want to hold off and see what we've got cooking. But it sounds like, given this development, that this product was perhaps even farther from being completed than anyone initially suspected. We'll see how this plays out, of course. We did bounce off the lows, so perhaps it's not as dire as it initially seemed, but still interesting development, and you guys are right. Not too often do we see big flameouts like this in Apple land, so that's certainly worthy of note in and of itself. I don't know if I can call it a flameout, but they certainly have had some flameouts in their history in the tech land. This is, of course, Hewlett-Packard announcing today that they are thinking about splitting into two companies, and that, of course, sent the stock on a bit of a rally, up about 5% to close at $36.91, and also saw the options off to the races today. They're averaging of late just a hair under 30,000 contracts a day, about 29,000 contracts, doing 110,000 today, so fairly robust. Not surprising given all the upside movement that most of the love was to the upside. It was about 2.1 calls over puts out there, about 75,000 to about 35,000 calls over puts. So interesting stuff going up out here in Hewlett-Packard. We have to wait to see how this one plays out, but clearly some activity. Mark, to this one, I'm sure this one caught your eye out there in the pit chat. What was the consensus out there? Anything interesting as a result?
It wasn't one we were paying an overabundant amount of attention to. What we've been watching is today was the semiconductors. And quietly, the volatility in like SMH and SOX is exploding. If you pull up a chart, it's incredible how high the vol's gotten in the semiconductor space right now. Looks like people are starting to think they're a little overloved.
Well, that doesn't surprise me at all, because if you've been paying attention to the odd block on this program or any of the other unusual activity alerts we do at the Options Insider, you know that the lion's share of them, particularly in the past month or so, have fallen in the semi space. So a lot of people are making a lot of interesting bets out there, and a lot of vol is moving as a result. So it doesn't surprise me that a product like one of the aggregate ETFs, like the Market Vectors SMH product, which closed today off a little bit, off about 20 cents on the day, is catching a little bit of a bid. And you're right, I'm looking here at the chart, and implied has been just pretty much on a steady tilt upward ever since about the middle of August or so. Actually, even earlier, started heading up north in July when it was trading in the low to mid 40s, and it has tilted up. Percentage wise, overall has had a bit of a move. We're seeing it get into looks like about the 46-47 range. We'll see if that keeps pace. But of course, given all the unusual activity we've seen, perhaps not surprising out there. Uncle Mike, anything else catch your eyes out here? The Hewlett-Packard news or anything else really cooking in GLD land?
Well, there's the dollar coming down a little bit today. We had a little bit of a pop in the shiny metal known as gold. So I'm kind of curious to see how much longer. I think the dollar, I'd seen somewhere today, I think the dollar has rallied has gone up 12 weeks in a row, and just curious to see if this will continue or not. Either way, we're hedged on the gold front. But I have to say, it was nice to see some green on the screen today in gold land.
So just to give people the Uncle Mike position update, you're essentially long stock input in both Apple and GLD, no other tweaks, no upside calls. Are you working any crazy front month near-term put spreads, anything like that?
Not today. Yet last week I did have a put calendar spread just because of the fact that I'm fairly out of the money right now with my long put on GLD. I'm down at 105. So I had a little bit of bearish calendar spread exposure to kind of balance out the deltas a little bit. And so obviously took some profits on that last week. And for the time being with Apple, still no short puts in any way. I had a small vertical last week that I took off for a little bit of profit in Apple, but didn't get into anything today. Just wanted to wait until tomorrow because I don't think an extra day will kill you. Just didn't see the setups that I had wanted.
And of course, the other big development in options land today was, we've been talking about it for quite a while, both on this program and indeed on Volatility Views. It finally came to pass today. That is the launch of the new version, I should say, of VIX, a new calculation, if you will, of VIX. Remember, we talked with great fanfare a few months back about, oh my God, are they going to add weeklies to the VIX? We quickly corrected that once we saw what they were actually talking about, just kind of smoothing out the curve a little bit. Well, it launched today, Monday, October 6th, so this is our first actual day using this new calculation. As we mentioned on Vol Views, they will continue to disseminate the old calculation as well. I'll have to pull up. He mentioned what the ticker was. I'll have to pull it up again so you can get an update on that as well. But yes, today is the first official day of a new era in the realm of VIX. Mark, did anything catch your eye about this new day worth of calculation? Was it pretty much as you expected?
Exactly what I was expecting, which means there was absolutely no change.
So it wasn't the wild free-for-all we were all pontificating on when we first heard this news, that they're going to add one day to go options and it's going to be crazy town.
Yeah, no, this is pretty much what you might expect.
Yeah, that's what we'll pay attention to. We'll watch it throughout the week, of course, because it is a very, very literally new development, and we'll see how it unfolds. But it sounds like it's going to be out there to kind of smooth out the curve a little bit, and we can anticipate more of the same going forward. By the end of the week on Vol Views, we'll have a better take on how it's playing out, and we'll also pay attention, do some compare and contrast, perhaps between the old, I guess you can say middle VIX now, because that's not the old. The old is the original VIX. We've got 3 different delineations now. It's getting a wee bit confusing. And before we keep getting even more confused, let's keep on rolling right on into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and welcome to the Odd Block. This is indeed the portion of the program where we break down the weird, wild, bizarre, interesting, and sometimes just downright head-scratching paper that's catching our eye out here in the options markets today. Going to kick things off with, I believe we talked about this one in the past, but it's been a while. This is Earthlink Holdings Corp., ticker symbol ELNK. Wouldn't be the Odd Block if we didn't dive into a few cheapies out here. And this one is indeed a cheapie to the tune of $3.39, closing essentially unched on the day, down a few cents. As you might imagine from the price of this name, it's not exactly an option stalwart, although it does do decent volume from an Odd Block perspective, at least doing about 2,400 contracts or so a day, doing well more than that, to the tune of 36,000 contracts today. So clearly some size paper afoot out here in Earthlink. And what caught our eye out here on the old mothership, theoptionsinsider.com, listeners, was some size trades, pretty much actually just one. That's odd in and of itself. One big print here in ELNK on the Jan 2015 4-strike to the tune of 35,829 of the Jan 2015 4 calls, going up for 15 cents, and essentially looks like this was a sale. And looking at the open interest out here of just a hair over 36,846 to be precise. This appears to be someone just giving in the ghost, just giving up here. He's got some time to go, clearly. Jan is not for a little while, Jan expiration. This guy clearly looking at the charts, looking at what's going on out here in Earthlink and saying, you know what, this 4-strike is not where the action is at. And I'm getting this 15 cents, and I'm getting while the getting's good. 15 cents, 36,000 times, nothing to sneeze at the end of the day if you want to keep living to fight another day. Look at the chart here on Earthlink, and it's kind of hard to argue with this guy. This thing was floating and trading well over 4 to the tune of nearly 4.5 not that long ago, about a month ago. This guy clearly thinking, hey, there's more room to play here on the upside. I'll have to look and see. I don't know when he opened these calls, but ever since essentially mid to late August, it's been a straight downward trajectory here. This thing vacillating, like I said, right around 340 for the last few sessions. Not looking good. This guy clearly looking at this chart and saying, hey, not exactly strong future prospects here for ELNK. Mark, this one strike you as interesting at all? Because at the end of the day, this is not something we see very often, not just the size going up in one block. That in and of itself is worthy of note. But the fact that this guy is essentially giving up the ghost on what was a pretty sizable bet and doing it pretty early. Either his fundamentals have changed, or he's saying, you know what, I got to take this money and run because there's nothing going here.
Yeah, I mean, I don't know. I mean, it's definitely an odd block, if you will. My guess is it looks like he put these on in at the beginning of September. My guess is he had a working theory and it has been proven wrong. And, he's saying to himself, I lost 40 cents on these. I might as well salvage what I can get out of it. And so it looks like he lost 50 cents on it. So he probably is taking his lumps.
Yeah, clearly he's saying this is not. This is just take what I can get and scrape it off the table and keep moving on All right, so one guy giving up early out there in Earthlink. Now we're moving on to someone putting something on for some decent size out here in Code. This is Spansion Inc., ticker symbol Code, CODE, closing today $21.23, down about 30 cents or so on the day, or about 1.4%. This is the name that does about 3,000 contracts a day. So for a relatively premium name compared to at least the names we usually talk about here on the old odd block, this one does some paper, does some decent size, and doing 8x that, doing 24,000 contracts today. So crazy paper out here in Spansion. And what we saw, what appears to be at least, are some stupids going up out here in Spansion. The first one that caught our eye was the Nove 29 calls going up 2,640 times for 35 cents. Looks like along with 1,680 of the Nove 20s by 1,280 of the Nove, OCC 25s going up for 275 and 25 cents respectively. All the paper went up in about 3 blocks. These are essentially, there's open interest on all of these strikes. I'm looking at them all now while we're talking, and there is some decent size on each of these strikes. Each one went up as a sale, marked as spread. Of course, we know how useful those conditional tags can be. We also saw 4,000 of these. These are actually something we covered earlier. You may remember this, listeners, back on September 23rd. We covered paper coming in, picking up 4,000 of the Nove 30s for 75 cents. That went up in large blocks as well. So interesting stuff. Size call paper going up about not even a month ago, a few weeks ago here on our unusual activity, and now following that up with these Nove 29s by this funky bit of a ratio, Nove 20 by OCC 25 spread going up as well. Like I said, size open interest on all these strikes, 6,000 on the Nove 29s, 2,660 on the Nove 20s, and 8,183 on the OCC 25. So serious paper going up here. This one is weird. We could parse this one any number of ways. I'm going to do something a little bit different here on the old odd block. Because it is a call stupid, I'm going to toss it over to Uncle Mike Tusaw first. Uncle Mike, there's a flurry of paper here. What do you make of this just essentially call palooza out here in Spansion?
Well, it's just your standard scaled-in diagonal call short stupid. I mean, it's just that simple.
Of course.
Yeah, and looking at this, it just seems like it's someone that is some large fund that has a lot of this stock, perhaps, and just all of a sudden someone learned what a covered call was and said, let's do this. Let's get some income going. And that was kind of fun. Let's go get some more income. That's kind of what this looks like in here in terms of the way with which this has been going over the course of the last the days with which this is reported. This is just a theory of mine, but what probably happened is that maybe one of the bigger bosses at some fund came down and said to everybody, we need income in this fund. There's no income in this environment. How come you're not doing anything about income? I can do some covered calls, boss. Then do it. That's my theory.
That works about as good as any, because it does. You're right. It does have all the hallmarks of this guy read an article on our site or someone else's or OIC or who knows somewhere, or picked up an option book last night and said, hey, these covered call things are pretty cool.
Maybe he read my BXY paper.
There you go. He read his leveraged approach to the BXY, because you're right. This guy just found every strike he could and just hit them en masse. Mark, you were just talking about last week about the leveraged approach to BXY. What do you think about this guy doing some crazy leverage in here in Spansion?
Hey, you know what? Code has been a crazy one. I get it, but I don't understand why. That's a lot. This is not like getting some income in Apple is one thing. Getting income in a 75 vol stock is maybe not as smart of an idea. That's just me.
Chances are when the vol is that high, it's high for a reason. This guy may discover that the hard way. I'll have to dig in and see again, listeners, if those Nove 30s I talked about before, that 4,000 lot, that was buying or indeed selling, went up on the 23rd. You can check out on our website, Indeed, the flagship, to find out more about that trade. But either way, this is just a premium palooza out here in Spansion. We're definitely going to mark this one as a to be watched because there's a lot to watch and a lot to parse. We'll have to see what the open interest is tomorrow on all these strikes to see exactly what this guy was up to. So you guys playing the home game, listening to this tomorrow can play along for yourself and see exactly what this crazy guy was up to in Spansion. Maybe you have your own ideas. Send them in. Let us know. We'd love to hear from you guys and see what you think about some of the weirder ones. And this one certainly is a bit of a weird one. All right, and we're going to wrap up the old odd block today with some interesting trades out here. And a name you may have heard of, FedEx. I'm not sure how you pronounce that. Ticker symbol FDX, of course. I'm talking about FedEx listeners. Closing today, 159.24. Taking it on the chin a bit, down about 2% or about $3.50. Not the best day for good old FedEx. This is a name that does about 4,200 contracts a day, doing over 4x that, doing nearly 19,000 today. So paper palooza out here in FedEx as well. And what looks like is interesting about this is that we're seeing people actually fading, looks like a little bit, this sell-off we're seeing in FedEx today, saying perhaps this is a wee bit overdone. Paper coming in today, trading 3,721 of the OC 157.5 puts at 75 cents. Not much open interest here, listeners, only about 190 contracts. That was the initial trade that caught our eye. As the day went on and progressed, we saw another 3,000 roughly piling in to the tune of nearly 6,600 total going up on this strike. So a fairly aggressive trade out here. It looks like this is mostly sellers out here. That initial chunk we profiled went up in one big block. The rest had some scattered size to it. People were hitting the bid a lot out here today. They started off at 92 cents and chased it all the way down to about 75. That early sale was pretty aggressive, as you might imagine. But this is not the typical paper we usually see when we see a decent move in a name like this. You usually see people using options to come in and scoop some deltas, get in on whatever the underlying move is instead of trading the stock. This appears to be very clearly people saying, hey, you know what, this is overdone. We also saw about 1,000 of the OC 165 calls going up. I should mention, by the way, these are all in the weeklies. That's where we saw a lot of the paper today, not in the regular OC, but in the weeklies. So, yeah, a lot of very, very aggressive paper given the duration of these contracts and the pretty much no open interest on either of these strikes. So it could be someone legging in to a ratio risk reversal here. Either way, people fade in this drop pretty hardcore. Mr. Seabass, take us home. What's your take on these guys essentially saying no mas to the sell-off here in FedEx?
You know, FedEx is one of those names where when it gets cheap, you have to move in and do something about it, and that's why this guy was making that play. The good names like that, you'll see this type of activity pretty often.
Yeah, this guy obviously thinking, hey, quality name, not going anywhere anytime soon. This is not the Enron of our times. And so this 2+% sell-off today, a wee bit overdone. This one's pretty near-term paper, so we can see by the end of this week just exactly how this one is going to fare. So two to watch in the to-be-watched column. Maybe we'll check back on Thursday, listeners, to see how our friend in FedEx is making out. Meanwhile, we're going to keep on rolling right on into our next segment. Like I mentioned at the top of the show, no Viceroy, unfortunately, but we do have Uncle Mike, so that means it's time for the Strategery block.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
All right, listeners, you know what that music means. It's time for good old Uncle Mike to come on down from the old mountain, smoking jacket and stone tablet, and perhaps bubble pipe if he's feeling frisky in hand, to dispense some options, wit and or wisdom. Some days we get both, listeners. Some days we get a little bit of one or a little bit of the other. It's up to him to decide what we get today. I, for one, am very curious. Take it away, Uncle Mike. The floor is yours.
All right. Well, I'll start off with a little bit of wit. What do Romans call IV? They're like implied volatility abbreviations. What do Romans call IV?
I think they would call that a 4.
That is correct.
Wow. Ancient Roman wit today. I was not expecting that at all.
Well, I had to start off with something. So anyway, today's strategy, I want to revisit what I was talking about a little bit last week. On September 25th, for my strategy in the simulated index concept, what I typically do for a lot of clients is let's say that someone has approximately $100,000 to invest. With 10,000 of it, we will have a plethora of call options, and with the remaining 90,000, we will have the money in much more safer things, such as treasuries or very tightly collared underlyings, things of that nature. Just everyone's different, so we really don't have any set rule for that. But for how we expose our clients to the call options, that's pretty uniform across the board. For some people, they're levered a little bit more than others. Some people aren't levered at all, and some people are kind of de-levered in some ways. But nonetheless, strategy with which we've been doing since pretty much as long as I've been a trader in some way, shape, or form is that we will buy a longer-term call option and then sell calls against it, or sell put spreads with additional capital being required, whatever the case may be, to finance some of the premium. On September 25th, made the decision to pull the plug on the February 199 call. And the reason with which we did that was not because I became bearish by any means. By all means, I am the world's most hopeless long-term bull of them all. But nonetheless, we kind of got into a situation to where I need to follow my trading rules. And I want to explain the why as to how what we're doing, and just kind of give you an update as to what we've been doing since the 25th of September. We went below our point on the S&P, meaning we went below 199, which was the strike price. We had originally rolled up to 199 because volatility was so low that I just could not resist buying some at-the-money premium because of the fact that with vol as low as it was, a wise man once said there had never been a better time to sell the market than at the current time. However, I was still bullish, so that was the appropriate strategy with which to play my long exposure to the market. Now, as the market was going downward, what we decided to do was just get out of that 199 call. Now, with that being said, should the market stay the same or go down with the market at the 197 level, or 196.5 is approximately where we got out, then I'm an obvious genius because of the fact that the time decay would expire had we stayed in that call, and if the market were to go down, then we had no call exposure whatsoever. So that part's the easy part. Now, the hard part is, what if the market goes back up? That's what I'm in defense mode for right now. Now, at this stage, 202 on SPY is where I will get back into that call option. Now, you might say, well, but Mike, won't you miss out between 196 and 202? And the answer is that yes, absolutely, I will miss out on it. However, with that being said, it is my prediction that should the markets go to 202 tomorrow, they may not, you never know, and I'm concerned about tomorrow more than anything. Should that be the case, I think it's a very safe bet that implied volatility would be lower by quite significant, or would be at a lower level and quite significantly if we were to have that kind of a move in the market tomorrow. So, with that being said, that 199 call, should I choose to get back into that at the 202 level, would be at a much lesser price from the standpoint of volatility. Now, yeah, I would be paying more to get into that, but what I'm saying is that when I got out of the market on September 25th, volatility levels had risen to the point to where it didn't hurt me quite as bad on the losing deltas. Now, yeah, the VIX didn't quite move as much in a lot of cases as it would on that kind of a downturn as it has in the past, but it did still come to the aid of the call option to an extent. Now, in the meantime, what I am doing, instead of just sitting in cash, I am being very picky about what put spreads to sell. Last week, we ended up selling a couple of put spreads, and we ended up profiting a penny on the put spreads with which we sold last week. However, the call with which we got out of we got out at $5.29. I'm just looking at this call option right now. The Feb 199 call, it's at $4.90 by $4.96, so we're obviously better off for staying out of it thus far. This week, or today as a matter of fact, I actually tried to get into another short put spread. I was actually trying to get into the 192, 187 for this week. I put an order out, but it did not get filled. So in the meantime, what I'm looking to do with that strategy is sell some put spreads to where if we just go sideways over the course of the next week, month, year, whatever the case may be, then we have the possibility of benefiting from time decay. And let's say if we do start to rally back to the 202 level to where we make some new all-time highs, that will give me the ability to get some of the money with which I would have gotten from that SPY long call. In my estimation, if it takes us another 3 or 4 months to get back to the 202 level, I think I can make my money back in short put spreads. That remains to be seen. But in the past, this has worked out for the better because of the fact that if the market does come back fairly quickly, volatility a lot of times going down does come to my aid in getting back in. So with that being said, that's one of the ways with which I like to look at the marketplace. I'm not necessarily bearish, but have to say it does shed a tear to my eye looking at my screen and not seeing my long calls in SPY. And that is all for today. I can't go on anymore.
Too sad, sir. Too sad to continue. Too saw. I almost went there. Too saw. Too sad. It's too much of a rhyming day, so we'll keep on rolling right on into, because we usually save it for Thursday, but you guys send in such great questions, we'll squeeze one or two in here today. It's time to open up the old mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, and welcome to the Mail Block. This is indeed the portion of the show where you guys get to chime in, make your questions and comments known to your fellow listeners as well as to us here on the old All-Star panel. A lot of great questions coming in, including some epic ones. We'll get to one of those here. I think first off, because it kind of ties in a little bit to what you were just talking about, Uncle Mike. This one comes from Alan out of very, very hot Las Vegas. Less so this time of year, but still just atrociously hot out there and dry. I couldn't handle it out there. He writes, "Hello, everyone. I just started listening to the podcast. I'm really enjoying it. I have a question about a strategy you've discussed in the past. As a covered call alternative, I was interested in possibly buying a leap with a 1 or 2 year expiration and selling monthly calls against it. When I looked up a few stocks and ran some preliminary numbers, I noticed that the cost to purchase a deep in the money leap, which was about an 80 delta, option was usually higher than the total money I would make selling monthly calls for the duration of the leap. What I did to get these rough numbers was to take the money earned from selling the initial 1 month call after commission costs and multiplying it by 12 or 24. I'm assuming one or more of these possibilities. 1, the method I use to get these figures is wrong, even as a rough estimate. 2, this option strategy only works with certain stocks underlyings that have optimal Greek numbers. 3, this method only works when assuming the underlying leap also appreciates in value to offset its own cost. 4, commission costs make this strategy less successful. He puts in parentheses what broker he has. That shouldn't make a difference. Number 5, and the rest of here, any information you can provide about this strategy is greatly appreciated. Thank you. Keep up the good work on a great program. This is a great question, Alan. We've had variations of this theme on other programs on our network. First time we've had a chance, I think, to discuss this on the old option block program, too. This is interesting stuff. You make a number of interesting assumptions here. I'll just hit a couple, then I'll toss it over to my compatriots here. The first off, I can see why you'd be tempted to do that, to say, hey, buy 12, buy 24, and that's our total return, because it is the easy way to do it. But as you write here in your number one estimate, that's not exactly the most precise way to do it. You can, of course, assume same levels of vol, same levels of out the moneyness, and that sort of thing to really make that work. And second, you're going to be doing this. I forgot what you said, 1 month calls here. So there's a lot of different ways you can play with these numbers to make these things actually work out a lot better. First off, you don't need to go 2 month. You also don't say how far. You say 8 delta, actually, so that gives us a better sense. I thought you didn't say, but you do say about 80 delta, which is a decent range for this kind of in-the-money stock replacement type with a covered call kicker type strategy that we like. First off, if you go out 2 years, you're going to be talking about a very, very long-term contract. It's going to take you a while to pay that off. But if you're okay doing those type of trades on the 24-month cycle like that you're talking about, it will work out in the longer term. Secondly, you could also play with this a little bit as well if you want to get it really busy, like Uncle Mike does. You can get into the weeklies, which has been shown over time to actually generate even more from an aggregate premium. Of course, you're selling products that are pretty much pure decay at that point, so that works out as well. And of course, listening to the rest of your assessments here. This method only works when assuming the underlying leap also appreciates in value. That's a good thing to assume as well. I'm assuming if you're going to hold this underlying for 2 years, you want some sort of appreciation on it. So that's something you probably want to factor into your equation as well. I wouldn't worry too much about commissions unless you get so deep into the rabbit hole that it could start being expensive. But I wouldn't really about commissions making this strategy invalid. Uncle Mike and Mark, we've talked about this quite a bit. This is kind of the old stock replacement with the front month or perhaps even weekly call kicker. Our friend here, Alan, saying he doesn't think the numbers work out. Uncle Mike, this is kind of similar to what you were just talking about, so we'll start with you. What's your take here on these four assumptions, essentially, from Mr. Allen?
Okay, a couple things, Alan. First thing that I would consider looking at is if you go that far in the money, it's going to be difficult to pay the whole thing down in a lot of stocks. The way with which I like to look at it is step one, if I'm looking at a very rough estimate, the way with which you're looking at it, and Mark's absolutely right, you can't assume straight line volatility for 12 months, much less 24 months, but just to kind of give you an idea of the concept, what I would look at on this, Alan, is determine how much time decay you have on the long-term call itself. So let's say that you're looking at an 80 delta option 1 year out, and as you're looking at, I'm actually going to bring up an 80 delta option 1 year out on SPY. So in looking at that, I am looking at an 81 delta option. I'm looking at the September 2015 165 calls. And the September 2015 165 calls, they're currently priced at, we'll just say $34, just to give us a rough estimate on this one. So that actually gives us probably about $3 of time decay on this option. So of the $34, and once again, this is a very rough estimate on this, about $3 of it is time decay. So if I were to do this trade, the way with which you're looking at it, and I've spoken on this show, I typically prefer 6 months for a variety of reasons, but I'm not going to get into that right now. I would view this as I'm trying to get $3 paid off within the next 12 months, approximately. And if I can get $3 paid off in the next 12 months, then it's the equivalent of owning a $196 stock for only a $34 risk. Now, that's pretty exciting to me. I mean, people talk about having portfolio margin. People talk about having single stock futures for these great levels of margin. To me, this is where the excitement comes in as to where longer term options can really be of benefit to you. So step one, look to just pay down the time value. Step two, a lot of times these are going to work in a lower volatility stock, and by lower volatility, I missed the Viceroy. This is something that I got from him. Volatility is low only if you think it's low, and volatility is high only if you think it's high. Mark might think that XYZ stock is very low vol stock, but I think it's really high vol stock. Everybody's different along those lines. What it boils down to, Alan, is that if you feel that implied volatility as a whole is going to go higher and over the course of this next year, and you feel that the stock's going to go higher over the course of the next year, then this could be a good strategy to match what you're trying to do. The reason is that you've locked in the volatility for a year on this 1 year call option that you're going to buy. You've also only have to be short 1 month worth of vol. So let's say that implied volatility goes significantly higher next month, then you still have the same vol that you bought originally on the longer term call, but next month you can double your pleasure, double your fun because volatility is so much higher. And that's where rising implied volatility could benefit you when doing something like this. Now, of course, the opposite is true if volatility were to go down. So the way with which I would look at this, Alan, is that I would try to get the time decay paid down and kind of have that type of mentality. And then to manage delta risk, meaning trying to manage all this in the money, option that you have, or I'm sorry, all this intrinsic value that you're buying, I would simply have a point with which you're wrong on the stock. Say, okay, if the stock goes down to this level, that's when I'm just going to get out of it. And in terms of commissions, well, that's usually not much of a factor unless you're trading like me, I guess. I don't know. So, but yeah, that is how I would look at it, Alan.
Good stuff, Uncle Mike. I tend to agree with the 6-month time frame as well. We talked about that many times on this show. There's a wealth of studies and analysis out there that show that's an optimal time frame for when you're buying premium versus writing calls and writing options against it. OIC has done some great studies on that. Check out the OIC Collaring the Q studies to look into that for more, Alan. And I think that's a good point, too, about changing his frame of reference a little bit. You don't think of it as just paying off the whole thing. Think of paying off that time decay. It becomes a much more practical proposition than being overwhelmed by the prospect of paying off this 1 or 2 year 80 delta call and all the work you have to do as a result. Mr. Greasy Meatball, anything to add here for our friend Alan from sunny Las Vegas?
You know what? I have a rule against messing with perfection.
So why are you even on the show, sir? This whole show is perfection.
There you go. There you go. Well,
right.
I'm part of that perfection, but
that's true. That's
true.
There's
really Mike hit the nail on the head.
All right, good questions as always. Like I said, we welcome all your questions, even some of the lengthier ones. They all provide good grist for the mill. Meanwhile, we're going to keep on rolling now. Right on into our final segment. It's time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, listeners, like the man said, this is the portion of the show we tell you what we're watching for the week to come. No Viceroy here, so I'll take his seat and say 10-year and the Bund and a few other things. Macro, because that's what he loves, and hopefully he's listening right now and cracking a smile. Meanwhile, Uncle Mike, we'll start with you. What are you watching for the rest of this week, sir?
Hong Kong. That's the one thing that nothing happened today, and it seemed like it was peaceful, but if for some reason things change rapidly there, I do believe that the markets will change rapidly as well. So that's the one thing with which I'm concerned. The other thing, which I don't have quite as much of a concern over, the U.S. dollar coming down a little bit today. Just curious to see if that 12-week run-up that it had is going to come to a little bit of an end, or possibly just a little bit of a break, and then seeing how that will affect my shiny metals. Not to be confused with the mini metals.
With the mini metals.
That's
favorite.
the band I represent, as you all know.
Everyone's favorite mini metals cover band. Mr. Mark Sebastian, when you're not busy booking dates, what are you watching for the week to come?
I agree with Mike. I think if there is any real risk, it's Hong Kong. It's not. It's not some of the other things that are floating around out there. Certainly not Ebola. I'll tell you, my general rule, I think I said this on Friday. I have two major life tips for everybody. One is if the stock market sells off because of Ebola, buy it. Two, if someone has Ebola, do not make out with them. All right? Those are my two life rules for all investors. And so that said, Hong Kong could be a real issue. That's the only thing that really scares me. If that thing smooths out, I think we're going to kind of meander higher anyway. So that's the way I see things.
That could be the title of your next webinar, tips for dealing with Ebola by one Mark Sebastian.
Don't make out with people that have it. End of tips.
There's a lot of places I can go with that. I think instead what I will do is just wrap up the old Around the Block segment and also wrap up this episode of the Option Block. But before we go, as always, let me check in with my cohorts here, my partners in crime, to see what they have cooking that may interest you. Until the next time we can all gather here together around the old ASP. Starting off with you, Mr. Greasy Meatball this time. We'll mix it up. What's coming down the pike in the land of the pit? We're going to be planning a new one-day webinar in November, so look out for that. I'll be doing a free webinar probably end of the month. I got to put that down. Don't have a specific date, but go to optionpit.com/blogs to see what we have going on and what we're thinking. And you can that's the best way to be up to date on everything that is Option Pit. Sounds like a plan, sir. And Uncle Mike, when people aren't busy surfing on over to optionpit.com, where should they head to learn more about all the doings and goings on over there at RCM?
They can surf down to Miami. By gosh, we are going to Miami. To quote my good friend Will Smith, who has no idea who I am, on December 10th for an RCM event. For more information on that, go to www.rcmfutures.com.
And that's part of your big CTA outreach program, is it not?
Yes.
All right, thank you for that, Uncle Mike. And on behalf of Uncle Mike and the Greasy Meatball and, of course, the Viceroy and myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show and for sending in such great questions. Keep them coming. We'll get to more of them on Thursday, I promise. And we'll see you next time right here on the Option Block.
The Option Block was brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.